Imagine handing over your hard-earned savings to a machine that promises to grow your wealth while you sleep. Sounds too good to be true, right? But that's the reality of robo-advisors, and today, we're diving deep into whether they're your ticket to financial freedom or just another tech gimmick. Let's kick things off with what a robo-advisor actually is, because understanding the basics sets the stage for everything else. At its core, a robo-advisor is an automated online platform that manages your investments using algorithms instead of a human advisor. It asks you a series of questions about your age, risk tolerance, goals, like saving for a house or retirement, and then builds a diversified portfolio for you, often with low-cost index funds or ETF. No fancy office meetings, no high-pressure sales pitches. It's all digital, accessible from your phone or laptop. Think about it. Traditional investing can feel overwhelming, with endless stock picks and market timing. Robo-advisors simplify that by automating the process. For example, if you're a 30-year-old with moderate risk appetite, it might allocate 60% to stocks, 30% to bonds, and 10% to international assets. This isn't random. It's based on modern portfolio theory, which aims to maximize returns for a given risk level. And the beauty is, it rebalances automatically. If stocks surge, it sells some and buys more bonds to keep your mix steady. But let's get real about accessibility. These platforms democratize investing for everyday folks who don't have millions. Someone starting with just $500 can get started, unlike old-school advisors who might require $100,000 minimums. Take Sarah, a teacher in her late 20s. She inputs her details, and within minutes, her money's working in a tailored plan. Over time, as she adds monthly contributions, the algorithm adjusts for life changes, like if she gets married or switches jobs. Of course, it's not all autopilot magic. You still need to monitor your goals, but the platform handles the grunt work. Data from Vanguard shows robo-advisors can help investors stick to their plans during market dips, avoiding emotional sells that cost the average investor 1 to 2% annually in returns. So, if you're busy grinding at work or raising a family, this could free up your mental space while building wealth quietly in the background. Shifting gears seamlessly, how do these things actually work under the hood? Robo-advisors rely on sophisticated software powered by artificial intelligence and machine learning. When you sign up, you fill out a questionnaire, maybe 10 to 15 questions, and the algorithm crunches your data to create a risk profile. It then selects from thousands of investment options, optimizing for taxes and fees. For instance, it might use tax loss harvesting, selling losing investments to offset gains and reduce your tax bill. Picture this. The system scans market data in real time, adjusting your portfolio as needed. If inflation ticks up, it might tilt toward assets like TIPS, Treasury inflation-protected securities, that hedge against it. Unlike a human who might overlook details, algorithms process vast amounts of info instantly. Betterment, for one, uses fractional shares so every dollar gets invested, no cash sitting idle. Let's illustrate with a practical demo. Suppose John, a 35-year-old engineer, invests $10,000. The robo-advisor diversifies it across 10 to 15 funds tracking global market. During a downturn like the 2022 bear market, it automatically buys more undervalued assets, buying low without you lifting a finger. Studies from Morningstar indicate this passive approach often outperforms active management over the long haul, with lower costs eating less into returns. Yet, the tech isn't infallible, it's only as good as its programming. Human oversight from the company ensures compliance, but the core is automated. This blend of tech and minimal human touch keeps things efficient, appealing to tech-savvy millennials who distrust Wall Street but want growth. If you've ever used a budgeting app, this feels like the next level, scaling your finances effortlessly. Now, onto the perks that make robo-advisors shine. First up, the sheer convenience blows traditional methods out of the water. You can set it up in under 15 minutes, and ongoing management is hands-off. For busy professionals, this means more time for life, not poring over spreadsheet. Plus, the low entry barriers. Platforms like Wealthfront start at $500, opening doors for young adults just building wealth. Cost savings are huge. Fees hover around 0.25% annually versus 1 to 2% for human advisors. That difference compounds. Over 20 years on a $100,000 portfolio, you could save $50,000 or more. Social proof abounds. Millions use them, with assets under management topping $1 trillion globally, per Statista. It's like having a financial co-pilot without the hefty price tag. Take real-world wins. During volatile times like the COVID crash, robo-users who stayed the course saw quicker recoveries thanks to automatic rebalancing. Imagine Emily, a freelancer. Her robo-advisor shifted defensively, preserving capital, then ramped up as markets rebounded. This discipline fosters a mindset shift, from reactive trading to patient growth. But it's not just numbers. The emotional relief is key. No awkward advisor calls judging your spending. Instead, dashboards provide clear visuals, building confidence. If you're skeptical, start small. Many offer free trials or simulations to test the waters, proving the promise of transformation from novice to empowered investor. Naturally flowing from benefits, we can't ignore the downsides because no tool is perfect. One big risk is over-reliance on algorithms during black swan events. Think 2008 crash, where models based on historical data faltered. Robo-advisors might not pivot creatively like a seasoned human spotting nuances. Limited personalization is another hitch. While they handle basics well, complex situations, like estate planning or alternative investments, fall short. If you have rental properties or stock options, you might need hybrid advice, blending robo with occasional human input. Fees, though low, add up, and some platforms charge extra for premium features. Performance isn't guaranteed. In flat markets, active strategies might edge out. Consider Mike, who used a robo during a bull run and thrived, but in sideways trends, he questioned if a human could have squeezed more. Market risk remains, your money's still invested, so volatility hit. Cybersecurity is a concern too. Though platforms use encryption, hacks happen. Always check for FDIC insurance on cash portions. Weighing these, it's about fit. If your needs are straightforward, pros outweigh cons, but complexity demands caution. Comparing robo to traditional advisors reveals stark contrasts, starting with approach. Human advisors offer bespoke plans, drawing on experience for tailored strategies, like navigating tax implications in divorce. Robos standardize, which works for most but lacks that personal touch. Cost is a game changer. Humans charge more, but for high-net-worth folks, the value in holistic planning justifies it. A CFP might integrate insurance, taxes, and retirement seamlessly, whereas robos focus narrowly on investments. Interaction differs. Robos are app-based, ideal for introverts, while humans build relationships, providing accountability. Data from CFP board shows humans excel in behavioral coaching, preventing panic sells that cost 1.5% yearly. Yet, for simplicity, robos win. Hybrid models, like Vanguard's personal advisor, combine both. If you're early in your journey, start robo, scale to human as wealth grows. This evolution mirrors how tech disrupts industries, forcing advisors to adapt or fade. Who thrives with robo-advisors? Primarily beginners or those with modest portfolios seeking set-it-and-forget-it ease. If you're 25 to 40, juggling career and family, this fits like a glove. No time for deep dives but want growth. Tech-comfortable users excel here. If apps intimidate, stick traditional. Risk-averse folks benefit from diversification, but aggressive traders might find it too passive. Example: Lisa, a nurse saving for kids' college, loves the automation freeing her for shift. Conversely, if you crave control or have a regular income, hybrids suit better. Data from NerdWallet highlights millennials as top users, with 60% preferring digital tools. It's about mindset. If transformation excites you, robos deliver. Spotlighting top platforms, Betterment leads with intuitive interfaces and tax optimization. Starting at no minimum, it's user-friendly for newbies, offering goal-based planning like emergency funds. Wealthfront shines in automation, with direct indexing for tax perks on larger accounts. Their Path tool simulates scenarios, helping visualize retirement. Vanguard's digital advisor appeals to conservative investors, leveraging low-cost funds. Fees at 0.15%, its value pack. Schwab Intelligent Portfolios adds cash allocation, though with higher minimums. Each has strengths, research aligns with your need. User reviews on Trustpilot average 4+ stars, showing satisfaction. Try demos to feel the fit. Breaking down costs, management fees range 0.00 to 0.50%, plus underlying fund expenses around 0.1%. No trading commissions, keeping it lean. Hidden costs? Some charge for withdrawals or advice add-ons. Compare. $10,000 invested at 0.25% costs $25 yearly, bargain versus $100 plus for humans. Long-term savings compound. Fidelity's tool shows fee impact. Lower ones boost nest eggs significantly. Always factor in, cheap isn't always best if performance lags. Finally, are they worth it? Balancing pros like ease and low cost against cons like limited advice. For many, yes, especially starters. Returns often match markets, per back-end benchmarking, with behavioral benefits adding edge. If goals align, the transformation's real, from scattered savings to structured growth. But assess your situation. Complex needs might tip toward humans. We've unpacked robo-advisors from basics to costs, weighing if they fit your life. Key takeaway. They're a smart, affordable entry to investing, but know your needs. Don't just think about it. Log in, answer those questions, and start building. Action turns knowledge into wealth. Procrastination costs opportunities. Check out the description or the first pinned comment, because I left some useful links and exclusive recommendations for you. And since you stayed until here, YouTube chose the best video for you to watch now. It's on screen for you.